This is a slide from our April 17th, 2018 video on Caliber's model for generating insights for high probability investment opportunities. You can watch that video, so we won't review this slide here. This video is a case study of how investment opportunities from our February hypothesis about opportunities created by dollar weakness actually played out in the markets. If you'd like to learn more about our process for investment idea generation, you can watch the April 17th, 2018 video posted on our YouTube channel or on our website at www.calibercap.com. Based on this quote from Albert Einstein, we'll cover an observation and hypothesis from late February that we posted to social media via our Twitter account in March. And we'll go through a live example of the evidence we observed, the hypothesis, and the market outcomes. Remember, our goal is not to predict, but to determine the probabilities of investment outcomes and act on confirmation. Our hypothesis from late February 2018 was that continued weakness in the US dollar would create investment opportunities in commodities, inflation-sensitive assets, and emerging markets. Now we'll look at 4 slides from February 23rd that outlined that thesis. You can see the date from February on this chart here. The chart shows the 15-year cycle of the US dollar. There are many reasons for the current US dollar weakness that are beyond the scope of this video. This chart covers the US dollar from 1972 through the end of February 2018. Notice that peaks in the US dollar have occurred roughly 15 years apart, separated by cycle lows. The last peak occurred in 2017, and the dollar is continuing to decline. Correlations change over time, as we'll see. The usual correlation is for the dollar to rise and fall with rates, reflecting economic strength and weakness. Here is the US dollar from the previous slide, and we've just added a black line to show the federal funds rate. There's one simple concept on this slide. When the Fed raises rates from a trough, noted here in green, there's usually a corresponding rise in the dollar. And when the Fed significantly increases rates, noted in red, there's usually a corresponding fall in the dollar. As you can see at the right side of the chart, the usual correlation is currently in question as rates and the dollar are on divergent paths. This is research that we just posted on our Twitter account. If you'd like to get our latest thoughts, charts, and research, you can follow us on Twitter using the @CaliberCap handle shown in the lower left-hand corner. If you don't have a Twitter account, you can still Google @CaliberCap. Insights for investing come from studying the markets and market cycles over very long periods of time. This slide shows the S&P from 1871 to the end of 2017 in the upper pane, and the yield on the U.S. 10-year note in the lower pane. During inflationary periods such as 1966 through 1981, long bond yields and stocks moved together. A turning point occurred when Volcker began targeting the money supply instead of rates in 1979. After a long deflationary period from 1981 through the end of 2017, we're seeing signs of entering another inflationary period. This has important implications for buy and hold investors or investors with 60-40 or 70-30 splits in their portfolios between stocks and bonds. In periods of rising inflation, bonds have a much lower probability of serving as an effective hedge against stock market downturns. Insights about long-run changes in the US dollar can help us identify investment opportunities since commodities are purchased in dollars. When the dollar is weak, it costs more dollars to buy commodities, and commodity prices rise. Again, this chart looks complicated, but it's not. The green line is the US dollar, and the red and black line is the price of a basket of commodities. You can see each of the 3 dollar cycle peaks here. As the dollar declines from peaks, commodity prices begin to rise. We included our key takeaways from February on this slide, highlighting what we saw as the investment implications of continued weakness in the dollar. We say implications because, again, we don't predict, We look at historical data and the evidence of the present day to determine probable investment outcomes. Let's look at how this hypothesis has played out thus far. This chart shows the performance of highly liquid commodity and inflation-sensitive sector ETFs relative to the performance of the S&P as a benchmark. Remember, we've had a significant correction from late January through April that impacts this slide. You can see that metals and energy are outperforming. Industrials and materials took a hit with the correction and trade war concerns, but are rebounding sharply. Gold and silver have shown recent acceleration, but are still underperforming relative to the benchmark and not places that we currently want to be. This is a ratio of S&P performance relative to emerging markets. A weak dollar benefits emerging markets. This slide is easy to understand. When the S&P performs better than emerging markets, the ratio is up. And when emerging markets outperform the S&P, the ratio is down. Note that at present, emerging markets are continuing to outperform because the ratio is down. We use an evidence-based strategy, not predictions. And we change when the evidence changes. Now let's walk through our hypothesis from February 2018. The event we observed was the peak in the 15-year US dollar cycle, which is a long-duration event that fits with our long-term trend following strategy. As with all long-duration events, nothing moves in a straight line, and in the short and intermediate time frames, there will be countertrends where the dollar strengthens. Over the long run, weakness in the US dollar will be transmitted to the markets via stocks, bonds, and commodities. Commodity ETFs, inflation-sensitive sector ETFs, and emerging market ETFs will go up, while bond prices and bond proxies, such as REITs and high dividend stocks, will decline. When price confirms our insights, we open positions. We capitalize on trend strength, and we exit as the trend deteriorates. There are a variety of investment strategies available to you directly from an investment professional, ranging from simple passive strategies to complex active strategies. As we covered in our April 11th video, if someone puts you in a buy and hold strategy during the run-up to the 2000 dot-com crisis or the global financial crisis period of 2008, you didn't make any money for 13 years. Buy and hold, or as we call it, buy and hope, may work if you don't need your money for decades. But most of us don't have that kind of time horizon. With the internet and availability of ETFs representing the major indices such as the S&P, the Dow, and the NASDAQ, you could do buy and hold yourself. These are the strategies most commonly provided to individual investors by financial planners. As you've seen from historical periods and the current evidence, there's a high probability that bonds used in these strategic allocation portfolios will no longer serve as an effective hedge against downturns in the market. Trend following seeks to avoid major losses of capital during major market downturns. We use dynamic asset allocation to shift from growth-oriented assets to defensive assets in times of market turbulence. Our trend following strategy also rotates over time to follow trends in sectors of the economy that have a high probability of outperforming the S&P. We believe that to be worth a fee, we should be providing value and insight, not passive strategies. We're portfolio managers. We focus 100% of our time on managing money. The best way to make money is understanding what is happening in the market and using our insight to identify high probability investment opportunities when market conditions are favorable, and to preserve capital in market downturns. We believe that combining evidence-based investing with our long-term trend-following strategy increases the probabilities of delivering satisfying returns for our clients. The information in this video cannot address the specific investment objectives, financial situation, or particular needs of any viewer. The information presented is solely for informational purposes and is not a solicitation or offer to buy or sell any security or financial instrument. None of the information in this video should be taken as investment advice. Any opinions expressed in this video are subject to change without notice. Caliber Capital Management, LLC, or KCM, is not under any obligation to update or keep the information contained in this video current. KCM, its officers, employees, or clients may have an interest in the securities, related securities, or derivatives of the securities referred to in this video. KCM accepts no liability whatsoever from any loss or damage of any kind arising out of the use of all or any part of this material. KCM recommends that you consult with a licensed and qualified professional before undertaking any investment decision.